Hi everyone, this is Solomon Serge, and today we are going to talk about understanding what moves the financial markets. Okay, so it is very paramount for you to know what moves the financial markets. You cannot just be trading every day without knowing why is the market moving, what moves the financial markets. Okay, so you need to know what you're doing. As a trader, you need to know what moves the financial markets. Or else you'll be like an employee who is being paid in a company without knowing how the same company generates revenue. Can you imagine you are in a company and you are just content with being paid without knowing how the same company you're working for is generating revenue? That is the same thing with a trader who wants to make money without knowing how the financial market works and why is the market moving. Okay, this one is very important. You cannot be a trader without knowing why the market is moving. It is your duty to know why the market is moving, and once you understand that, it will be easier for you to know even the direction of the market and even to know how to make money effectively, because you know why the market is moving. Okay, so what you should know about the financial markets. The first thing is that the financial market is a zero-sum game. Okay, zero-sum game means if you buy, it is because somebody is willing to sell to you, and if you sell, it is because somebody is ready to buy from you. So everything is regulated through the interbank. So the process of buying and selling is all regulated by an interbank. I hope you understand. So this is something that is very important. But the second definition of a zero-sum game is what is more correlating to the financial markets, which is your profit is somebody's loss and your loss is somebody's profit. So which means if you make profits, just know that the profit that you are going to withdraw in from your trading account into your debit card is somebody's loss. And what you are losing, just know that on the other side, there is somebody who is gaining from your profit. There is somebody who is gaining from your loss. Because you are losing, somebody is getting it. And this is why we say the financial markets is a zero-sum game, because your loss is somebody's profit and your profit is somebody's loss. Okay? Very, very important for you to understand. This is the reason why you need to know that the market will always be a zero-sum game. Let's move on. The market moves in order to achieve equilibrium. And the place of equilibrium is a place where contracts are found. So everything that is happening with the market, it is because it is seeking equilibrium. And when it does not find equilibrium, it moves in order to find equilibrium. Okay? It finds equilibrium when buys and sells are equal. Okay? And when it does not find that, it seeks to move either on the upside or on the downside. Okay? So the market moves in order to achieve equilibrium. And the market and the place of equilibrium is a place where contracts are found. It is a place of liquidity. So when there is equilibrium, then there is liquidity. Okay? So you might find the word contract. What is a contract? A contract is an order. So this is why, as we talk about contract action, it is trading where you are not trading just as a price action trader, where you are checking out trend lines and all that. No, as a contract action trader, you are looking for a place where there are orders. And where orders are found, it is where the origin of a move is found. This is why we say contracts create the origin of the move. You see? So the market moves in order to create equilibrium. And when there is no equilibrium, the market will keep moving. Okay, and when it finds equilibrium, the market will balance itself. I hope you're able to get that. So now, here's one thing that you need to know. Contracts also respect the law of supply and demand. and so does equilibrium. You need to know that what moves the financial markets, there are many factors that you might have or might not have known, like political factors, ecological factors, every economical factors. All those things do not just move the market anyhow. They move the market in a direction, in whichever direction, so that there should be equilibrium in whichever direction the market goes. This is why I say the news tell you how the market might move, but the contract action, the charts, will tell you up to where it's going to move. Okay, so where is it going to start and where is it likely going to end? The news will never tell you that. Okay, so this is the reason why the market moves in order to find equilibrium. There might be political issues, there might be economical issues, there might be social issues, there might be geopolitical issues. All those things move in order to achieve what? Equilibrium. So when they say that there's a political war and the price of a certain currency drops, when it drops, it does not just drop in order because they've said it has dropped. No, it drops because besides the fact of it dropping, it is looking for an area where it can bounce from. And when it drops, it is creating what we call an imbalance. You get a point? So you, as a person who knows contract action, will never be bemused by any news that happens even unexpectedly, because you know where the orders are, where the contracts are, and you know what to do, and you know where it's likely going to end, and the news will not tell you that. But you, as a person who looks at the charts and see where the orders are, you can know when the move is going to end and when a new move is likely going to start. So that is the advantage of a contract action trader. Okay? So contract also respects the law of supply and demand, and so does equilibrium. So let me try to show you something that is very, very important. Okay? Very, very important. Here we are, understanding what moves the financial markets. Okay? So now, let me try to show you something. Here is something that will allow you to understand that contract action respects supply and demand. Okay? It respects supply and demand, even though supply and demand is just the beginning of it. But supply and demand is also very, very important for you to understand contract action, because supply and demand is the basic of contract action. And supply and demand, number one, is not support and resistance. That is the mistake many people do. They think supply and demand is support and resistance. Hell no. This is something different. Okay? So now, here we have a graphic. And this one is a graphic that denotes the price up here. We have the price in dollar. And here we have the quantity. Okay? 1, 2, the price, $1, $2. And we have 3 of them. So now, the arrow that is going upwards denotes the supply, and the arrow that is going downwards denotes the demand, because the demand would want to buy more at a lesser price, while the supply would want to supply more at a higher price so that they make more profit. Okay? So we have these same charts in these 3 forms. Okay? So P is for price, Q is for quantity, S is for supply, D is for demand. So P is for price, Q is for quantity, S is for supply, D is for demand. Okay, I hope you understand that. I would want you to focus. So let's say, for example, the demand wants one quantity Okay? The demand wants one quantity of orders at $2, but the supply is having two. Okay? So let's use it in terms of contracts. Let's say the demand wants one contract, and the supply, you have seen the line here, has two contracts. So the demand has got one contract that they want, and the supply has got two contracts, and all of them are the same price of $2. So because the supply, they already have two, but the demand only wants one, now there's what we call a surplus. Okay, there is a surplus because the supply, people supplying, are having two contracts, while in the demand they are only having one. They only want one, and now there is a surplus. Okay, if we have to use it in terms of TV so that you understand very well, there is a demand for one TV at $2, as you can see. And now the suppliers is having two TVs at $2, but they only want one. And because they only want one, and there are two, then you see that there is a surplus. Okay, there is a surplus. So that's the same thing also with this second graph. Let's use TV so that you understand. Then afterwards we are going to use the contract. So in the surplus, you see here that the supply is having what? One quantity of TV for $1. And the demand, they want two TVs at the same price. Two TVs at $1. But the people supplying only have one. So because they have one and the demand is two, what is there? There is a shortage, isn't it? Okay? So now, because there's a shortage, you see that they do not agree. Okay? And now, going to the third one, you see that here, the supply, people that are supplying have got two TVs at $2, and people that are demanding, they want two TVs at $2. And because they are meeting at an intersection, this is where we find the equilibrium. And this is the perfect part of the market. This is the perfect representation of the market. So the market seeks to have this equality. And this is why we are talking about equilibrium. And now, one thing that you need to know is that all these TVs that we are talking about are contracts, and they can be traced on the chart. We are going to talk about that. They can be traced on the chart. And now here is the issue. The shortage and the surplus is what we call imbalance. Okay? Imbalance. Imbalance is the search of liquidity, the lack of liquidity. Okay? So when you see an imbalance in the market, you should not say that, okay, the market has got more liquidity. No. The market does not have liquidity. Okay? The market has liquidity at a place where equilibrium is found. And if there is no equilibrium, then there is no liquidity. So, a sharp move, how do you spot an imbalance? An imbalance is happen when there is a shortage, number one, or a surplus. Okay? So an imbalance happens when there is also a sharp move in the market. Once you see a chart, okay, let me try to represent something here. Once you see the market going upwards, and all of a sudden, you see something like this. This is an imbalance, and it does not show that there are strong sellers, not at all. It simply shows that there is a lack of what? Of liquidity, and it is in search of liquidity. This is imbalance. And imbalance also happens as a form of a market gap. So you see the market goes like this, and all of a sudden there is something like this. Then the market continues. Then you ask yourself, what happened here? It's an imbalance. Okay? So how do you spot an imbalance? An imbalance is a lack of liquidity. Okay? Is a lack of liquidity in search of liquidity. And it is spotted, number one, through a sharp move, and number two, through a market gap. I hope you're able to get me. So, as you said, the market moves to achieve balance or equilibrium. Okay? So now imbalance happens when there is a shortage or a surplus. Okay? So when we talked about imbalance and all that, we talked about it because you need to know that it is a shortage or a surplus. And imbalance happens to seek equilibrium. I hope you are getting it. I have explained it as simple as I could so that you can understand it very well. Okay? So now, as you need to know, imbalance can be spotted through the sharp and impulsive move, and also through the market gap, just as I've explained here. So now, next time we are going to talk about contracts, and also how contracts are created by the interbank and the market makers. Because you need to know that as retailers are trading, it is not the same way as institutions are trading. Okay? And you need to know that even as we are talking about a smart money concept, a smart money concept is just an introduction to order action. And it is not even the end. The smart money concept is simply the introduction. And now, through this course, you'll be able to see how you can get in depth of these markets and be able to get moves from the origin. Okay? So contracts are created, number one, through the smart money and dumb money. So which means the creation of manipulations and stop hands and all that, which is the beginning, which is the fundamental level. Okay, and number two, also through the specific areas of interest. That's when we enter in depth. And also through areas of supply and demand, of which we'll talk about how to find a real supply and demand, the characteristics of a valid supply and demand, how not to miss a valid supply and demand. So these are the things that we'll be talking about in the following course. Okay, so I hope you have gotten something. I would want you to get back and try to understand what I've told you. So these are the things that move the market. And now I've given you the basics, and we'll keep on learning more about how now to find the real supply and demand and all that. Then when we are done with that, that's when I will get into serious contract action, where you get pinpoint entries for NASDAQ, but also for any other market. Okay? Thank you.